do a quick introduction for anybody that has not been. We did invite a lot of people that have not been with us because this is just one of those opportunities to be helpful. Every day, every weekday, Dan and I have made the commitment to go live. We just call it Seeking Certainty, but it's just going live every day, talking to our clients about what's going on, how to think about it, maybe bringing on guests. We've had Bank of New York, Bernstein, the sleep doctor, Michael Bruce, just providing the resource to help our clients and our partners kind of get through all the stuff going on right now and navigate the waters. And today, Dan is going to break down the CARES Act. It was 880 pages, and to save you the time of figuring out what to worry about and what to focus on, and perhaps more importantly, what to ignore, Dan's just going to break it down, and then we'll do questions at the end.
Cool. Yeah, and here's the good news, Nick. Not only are we going to go through the CARES Act, but there were two other pieces of legislation that were passed before that, so we're going to talk about those too. So it's
Awesome.
not 880 pages of fun. It's probably like 1,100 pages of fun, something like that. So with that, I'm going to do a screen share and let me know if you can see things okay.
I can see your desktop. There we go. Yep.
Cool. All right. Well, here we go. Let me actually change my screen share here. Sure I did the right way. All right. Okay. All right. Can you see the slides now without all my notes?
Yes.
Cool. All right. So just kind of jump into things, since I think there's a lot of folks in here that don't. That doesn't necessarily mean much to a lot of folks, but there's some nice fancy credentials, I suppose, just to, I guess, give you a little bit of background. Have always sort of considered myself to be more of a entrepreneur, always scheming on business ideas. My lucky parents trying to rein me in. Got a degree in accounting and also a degree in information systems, thinking that would be the broadest skill set to start a business. And then I went off and did a fellowship at the board that writes all the accounting standards, so FASB and GASB, and basically worked on a derivatives and hedge accounting standard, which kind of put me down this whole other weird direction of being kind of a derivatives capital markets so-called expert. So did that for a while, moved around, worked for a Warren Buffett-backed company, getting ready to go public, and then I worked in strategic finance, and then worked in tax, and then finally started my firm, Nth Degree CPAs, 10 years full-time here in May. And we were recently, last year, rated one of the 10 best-run mid-sized firms in the U.S., which I'm pretty proud of. All that to say, that's a bit about me. And my background is, as I mentioned, working with the board, spent a lot of time doing research. So this isn't my first time having to read 800 pages of technical stuff over a weekend. So with that, get into the meat of it. So as I mentioned, as kind of the tease, there wasn't just the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. They always like to come up with these cheesy acronyms, or maybe this is a mnemonic in this case, but they always like to come up with these fun little acronyms on the bigger, more meaningful bills. So we haven't just had the CARES Act, which is the really meaty one, the 880-page document. We had two other prior to that, the Coronavirus Preparedness and Response Supplemental Appropriations Act on March 6th. These are all mouthfuls too. And then on March 18th, we had the Family First Coronavirus Response Act. And so the combination of these three makes it kind of confusing to keep track of everything that's going on when we've got really three separate acts. And amongst those three separate acts, there was a bunch of speculation about what would ultimately end up in these. In your mind, something that was just speculation that didn't end up in one of these acts, or you may be attributing something to the CARES Act that was was actually in one of the prior acts, which can kind of make it challenging when trying to figure out the source material for something. So we've got a combination of really three things going on. And to some degree, the CARES Act did add some clarifications to some things that were in the prior acts. So with that, kind of dive into things. But first off, what I always like to tell folks is that we need to make sure that we really know the direction that we're headed before we just jump into trying to implement strategies. I always think about kind of if you've ever done a scavenger hunt. I've done a few of them, especially back in my corporate days, because for whatever reason, big corporations think that those are going to be really fun team building exercises. So done a bunch of these scavenger hunts. And if you haven't done one before, basically you're given all these clues and then there's a time limit and you're set off, try to find all of the items on the scavenger hunt from the clues, and you're divided up into teams, and it's this competition, and the team that wins is the team that got the most number of things correct and in the shortest amount of time. And often what happens is that a couple of the groups just take off right away, and they're going to just all out sprint to try to win this hunt. And so they're just off and they're just running to each place. And maybe it's also like the fittest people in the office that are just thinking they're going to crush everybody else. And then there's one group or a couple of groups who spend a few minutes and they get really, really clear on what their game plan is, and they kind of map things out. And maybe they aren't doing an all-out sprint, but they're being incredibly strategic. And from my experience, those are the teams that win. The team that spent a few minutes, 5-10 minutes, really getting clear on what exactly they're going to do and how they're going to execute. And so by way of analogy, the same is true here, where we need to get really clear. And so the first step is understanding your current position. So what is, for your business or your personal financial situation, what's your current run rate? So what are your committed revenues or committed income streams compared to your committed expenses? And then how much do you have in assets? Short-term would be things like cash. Long-term are more like your fixed assets, things that are less liquid. Then our liabilities, current, so things that are due in less than a year, and long-term would be anything that's due more than a year out. But this is where we also need to be clear on things like unearned revenue, gift cards, for example, or deposits that people have made that maybe are refundable, and you don't necessarily have this reflected on your financial statements because when you got paid, you just considered it revenue. But really, these are liabilities that you have outstanding that you need to be aware of because these folks may come back and ask for a refund. And then getting really clear on the risks that you face. And we talk a lot about in previous calls about trying to hedge our downside risks. And we've got a downside risks that are both worst case scenario, so things that continue poorly. Takes a while for the economy to reopen. But there's also these best case scenarios where you reopen the business or the economy picks back up, and where the risks associated with being able to service all of your clients. So having a clear understanding of those risks. And then also in terms of understanding your current position is that absent these three new acts, from my experience, there's just a ton of tax deductions and credits that are really assets that are out there for you already that you just weren't aware of. You didn't know that you didn't know. And so things like the Augusta loophole, the R&D credit, which a lot of folks think just applies to technology. It applies to 48 different industries, including farming, as an example. So R&D credit, work opportunity credit, FICA tip credit, being a real estate professional and taking advantage of some of the additional deductions there, like cost segregation studies on your residential or commercial properties, or also taking advantage of cost segregation studies if you own the business the building that your business is operating in. Partial dispositions, de minimis fringe election, paying your kids and taking a deduction, the 1202 exclusion, capital loss harvesting, so on and so forth. I tried to rein myself in, but there's a list of 40 or so different deductions and credits that are usually a starting point whenever I'm working with clients. So you may have some assets that are really just already sitting out there, cash that you can go back and get by amending prior returns just simply because you weren't aware of all these different deductions and credits. So that's just part of understanding your current position. Then we want to get clear on your priorities. So what are we optimizing towards? And I always say to folks, we're not a big corporation. We don't have a huge team typically, which means we can't really maximize. These big corporations are about maximizing shareholder value. They have the team and the resources to be able to do that. We have to optimize what's the most efficient path forward. So getting clear, mapping out our priorities, things like I want financial freedom. Well, if you want, or I want financial certainty. Well, chances are if you want financial certainty, now might not be the time to put all of your money into the stock market, which is a big question that folks have been asking recently. So what are your priorities? Similarly, if you're trying to work 10 or 20 hours less per week, and that's been a priority that you're working towards, taking on a bunch of debt right now, probably not getting you closer to that priority. So we want to make sure before we start executing on strategies that we've got clarity on those priorities, that we've rank ordered them, and that we've assigned a dollar value and timeline. So having financial freedom, there's a dollar value to that. Having 10 more hours per week, there's a dollar value to that. And happy to help you quantify that separately. So once we've gotten clarity on those priorities to optimizing, and there's a few different buckets towards that. There's cash flow engineering, which is systematically aligning our cash flows with our revenue streams and hedging downside risks. Part of that is the work that we did initially when we're trying to understand our current position, which is where we were getting clarity on what our run rate is and what are the worst and best case risks that we have. But how do we go about then realigning our cash flow to support that? Identifying any hidden assets, and then evaluating additional revenue streams. And I put together a training last week that I call Maslow's hierarchy of revenues, which is, if you're familiar with Maslow's hierarchy of needs framework, and using it to create, based off your current business and your current assets, several levels of revenue streams. So going through that process, that's part of the optimization. Everything's connected back again to your priorities. But then this is where we're looking at tax strategies and access to get between the two, because as we start to get into these three different acts, some of it is tax strategies. A lot of it is actually access to capital. So loans, loan forgiveness, some grants. And so those aren't necessarily tax strategies. And so we're running a couple of different races here. And I wanted to just make sure that we've clarified that those are two separate things. Nick, how am I doing? Are there any, I'm not paying attention to any questions. So
We'll just roll and we'll keep questions to the end. If we have to, we could spill them over into tomorrow.
Great. Okay. So starting with the very first bill, and again, these are mouthfuls, Coronavirus Preparedness and Response Supplemental Appropriations Act. Most of that just spelled out some additional funding for public health and other governmental resources. But this is really where the SBA disaster loan really initially took shape. Well, I should clarify, the whole disaster loan framework is not a new structure. It's been around for things like hurricanes or just other natural disasters, where the Small Business Administration will make available a disaster loan. And in this case, this specific disaster loan to the coronavirus and any economic loss or economic hardship that you're experiencing. And there's loans available up to $2 million in assistance, 3.75% interest rate, and you apply at the link that I have listed here. This has been a moving target. I put together a training, I think 2 weeks ago, and over the course of those 2 weeks, the nature and process by which you apply for the loan has changed. So we've had online web forums that you could submit data to, or you could mail, fax in applications. Then they had bandwidth issues, so it moved to a different structure in terms of filling out documents through PDFs, and then you're uploading it. And then this morning when I was tidying up these slides, I noticed the entire URL is different, and some of the initial questions that you ask in that process has changed a bit. So the look and form of the application has shifted, but at the end of the day, the process here is not too dissimilar from submitting an application for a home loan, where you're providing a lot of information around your personal financial statements and background about the business, address, ownership, details about the owners. And those initial pieces of the application can feel pretty onerous because it's a lot of data. And then you get to the most important piece, and this is where I see folks taking shortcuts, which is listing out your revenue and expenses and providing a description or support for how you've been economically impacted by the coronavirus. And ultimately, the decision making, as I understand that the SBA is making, is that they're going to bias towards those applicants which are showing a data to support that they have in fact experienced an economic hardship. And so if you spend too much time on just getting all the general information together, and then you kind of cut corners and just put together a couple of sentences on the economic impact to your business, you're really doing yourself a disservice. The latter part of the application is arguably the most important. So I just want to emphasize that. But your perspective on the disaster loan and whether or not you would complete this application if you have not already may shift as we get into the CARES Act and some of the new stuff that exists there. So we'll come back to this. Then we have the second act that was passed on, I believe, March 16th, which is the Families First Coronavirus Response Act. And again, it provides a bunch of different things that aren't just tax related in the bill. But most notably, the act provides for emergency family and medical leave benefits, emergency paid sick leave benefits, and employer and self-employed tax credits. The Secretary of Treasury was basically given the power to determine essentially when these credits in particular would take place. And so the determination was that for any wages related to this credit begin April 1st through the end of this year. And so for all intents and purposes, the benefit that you might derive doesn't begin until a couple of days from now. So only wages paid starting April 1st through the end of the year. So with that, what are the credits? So basically, irrespective of the size of the company, you need to provide sick leave benefits to your employees. And there's a few different buckets to it. The first is that you need to provide 2 weeks or up to 80 hours of paid sick leave at the employee's regular rate if they are sick. Sick meaning they've tested positive for the coronavirus, or otherwise they just are exhibiting symptoms that would cause you to want to effectively have them be quarantined. So you need to provide up to 2 weeks. This is for full-time employees, 2 weeks. If they're part-time, you need to give them the average hours over a 2-week period of time. So if they average 20 hours a week, then they need to get 2 weeks of paid sick. That is equivalent to 20 hours for each week. So they get 40 hours in that example. And the credit that you get is for wages up to $511 per day. So it's the lesser of what their day rate is, or $511. Or you need to provide them 2 weeks of paid sick leave at 2/3 of their regular rate if they're caring for a family member. So it's an or, not an and. So it's weeks if they're caring for a family member. So it's not 4 weeks total of sick time for them as an employee, and also if they're caring for their family member. It's an or, not an and. And in this case, you need to pay 2/3 of their regular rate. Of course, you can choose to pay 100% of their regular rate. This is just what's effectively being mandated. And you receive a credit lesser of 2/3 of their daily salary, or $200 per day. And then separate from all of this is that once they've used up either the 2 weeks of sick time because they're inflicted, or 2 weeks to care for a family member, you have an additional 10 weeks at 2/3 of their regular rate if they need to care for a child. And similar to when they're out sick to care for a family member, you get a tax credit for 2/3 of their regular rate, up to $200 per day. Nick, did you have something on that?
No, I was just taking more notes.
Cool. So we got a lot of info obviously up on the screen. This is actually like summarized down from all the stuff that's on there. So this is for employees. Now, if you're self-employed, you get a similar refundable credit. And so you get 100% of self-employed income up to 10 days. And it's a similar credit where you're getting the equivalent of $500 per day if you're sick, or $200 per day to care for a family member. In this case, the wrinkle is your self-employed income, which is not necessarily your wages, because some of us are sole proprietorships and we don't receive a wage. Our self-employed income is our revenues minus our expenses. So our profits are our self-employed income. And so we take our annualized self-employment income and we back into a day rate. And that day rate is going to be our credit, assuming that it's up to $511 per day. So for all intents and purposes, a self-employed person gets the same benefits as an employee. Just the calculation is just a little bit different, in the sense that your self-employed income is not necessarily just a straightforward. So we both self-employed and employees receive this benefit. Now, what the CARES Act did is it provided some advanced funding for these payroll tax credits. Now, the way that advanced funding is the mechanism in which that's going to happen, not clear to me yet. We're still waiting on the actual procedures for how to do this. So if you're not familiar, what happens is that we get a bill or an act, CARES Act, and then that spells out effectively the rules and to some degree the principles. They aren't always as clearly articulated as a rule. But it doesn't give us the step-by-step mechanisms and the forms that need to be filled out in order to actually receive these credits. And so we're still waiting for this exact guidance on how to get these advanced payroll tax credits. But what I'm expecting that to come out soon, and it's really is going to, I think, shift a lot of the burden to payroll providers, so Intuit, ADP, Paychex, et cetera, to be able to administer these credits on your behalf. So more on that soon. As soon as I know that, I'll share it with you all, and hopefully in the next day or two, on how we can actually get the advanced funding for these credits, because clearly you're otherwise needing to pay this out to your employees, pay for their sick time, and so ideally we're getting a credit at the same time to offset that cash that's going out. So hopefully we'll get clarity on that soon. That's really what we got from the Family First Coronavirus Response Act in terms of tax credits. Again, it provides some other funding sources. So then we move into the 880-page document, which is composed of, again, a ton of different funding elements. And I'm sure most of you at this point have seen all the different depictions or pictographs of funding that's going to big corporations versus small corporations and all the different departments across the US government and all of that. But I'm just going to focus on the loans and then the tax credits and benefits that go to individuals and small businesses. Starting with the loans because that seems to be what the most amount of interest is at this point, at least from what I've seen from online and from questions that I've had come in. So the most notable one is what I'll just call the Forgivable SBA Loan Program. And unlike the SBA disaster loan, this loan is through banks and credit unions. So you're not going to the SBA disaster loan website to apply for this. This is administered through banks and credit unions that are SBA approved lenders. And if you need access to that, I've got a roster of lenders that I can connect you with. And so again, not through the SBA website. You don't apply through the website. For the forgivable SBA loan programs, you're going to apply through a bank or credit union. The loan amounts are up to 10 million, but more on that in a moment. And again, unlike the economic disaster loans through the SBA, this isn't tied directly to establishing losses. And there's no collateral or guarantees. So to some degree, this is seemingly a more streamlined process. And the general eligibility, it's really targeted to 500 employees or less. But you need to include affiliates. So this was intended to capture private equity companies, for example, who may own several individual businesses that add up to more than 500 employees. There is a carve out though for individual locations and effectively for franchisees. So while the total company may be more than 500 or thousands, there is somewhat of a carve out if you've got individual locations that have less than 500. And so the way that we calculate the amount of the loan is that we get the lesser of 10 million or 2.5 times the average monthly payroll incurred in the 1 year period before the date of the loan. So basically we look back over, as I interpret this, over the last 12 months from when you're executing the loan. So if it's April 1st, we'd look back March 31st, back 12 months. I think there's also an option to use the last calendar year as well. So we could opt to use 2019 or use the last 12 months. That's not entirely clear, but I think that this is going to be ferreted out with respect to the banks and as they get more guidance. So I think we can use either the rolling 12 months or the previous 12-month calendar year. And so it's the lesser of 10 million or 2.5 times that average monthly payroll. And what gets included in those payroll costs are several things. There's the salaries and wages, tips, sick time, severance, retirement benefits, and health benefits. But each individual employee is capped at 100,000 in salary. So if you've got higher paid employees that receive more than 100, you got to reduce their amounts down to 100 plus any other salaries from employees less than 100 grand. Take that number, that average monthly number times 2.5, and that will be your potential loan amount, assuming that it's not more than 10 million. So that's the amount of the loan. And then the loan cannot exceed a 10-year term and an interest rate of 4%. Again, you're going to go with a bank or credit union to get access to these loans. And I think there's going to be some negotiation or options that you have in terms of the term length and the interest rate. But effectively, you need to use these loan proceeds for payroll, healthcare, interest, mortgage on any property that you're using for the business, rent, utilities, and interest on any other debt. So I've had some folks who have who've sort of schemed a bit on well, can I take this loan and then, well, let me come back to that actually on the scheming. I'll come back to the scheming. I appreciate scheming. So now we get to the piece that everyone's excited about, which is the forgiveness of the loan. And so generally speaking, when you have debt forgiven, it's taxable income. But there's an exception based off the CARES Act where we can have this debt forgiven and we don't have to pay tax on it. So essentially, it's almost like a grant. We receive the money, it's tax-free. And so here's the criteria to have the loan forgiven. Basically, the amount had to be used for payroll, healthcare, etc. In the 8-week period beginning on the date the loan was originated. So we take that 8-week period of expenses after the date that the loan was originated, we add all of that up that was attributable to payroll, healthcare, interest, etc. that we have called out here, and that is the amount of the total loan that you can have forgiven. So if you use those funds on other things, operating expenses, then the debt will not be forgiven. In other words, this is set up in a way that's intended to discourage you from taking the debt and then or borrowing the funds and then laying off your employees. However, the Act acknowledges that some employers have already reduced their salaries. And so some employers have already reduced their salaries or they are planning to do so. And so essentially this gives you a carve out or some time to hire these folks back. So if you made some changes in your staffing, either by furloughing employees or reducing their salaries or letting them go, and you've done that between February 15th and April 26th, then you have time, basically, as long as you rehire your employees and return your adjusted salaries back by June 30th, your forgiveness will not be reduced. Again, though, you have to use these funds during the 8-week period after the loan is funded towards payroll costs, healthcare, etc. So this is where there's been kind of this scheming on the bill where folks sort of went, well, can't I get this loan, let everybody go, and then use those funds on my operating expenses, and then I just need to make sure that I hire them back by June 30th. I believe the answer is no on that, given the specific statement around the 8-week period beginning on the loan origination date. So I don't believe that you can just take the debt, let everybody go, and then hire them back on June 30th and have the debt forgiven. Nick, any questions on that? You have any clarification?
No, that all makes sense to me. I'm just following along, keeping track of questions here so we can knock those out when the time comes.
So I don't think there's a whole lot of downside to applying for the loan, given the interest rate, given the term relative to what your other debts may be at this point. And this is done directly through the bank. Now, you may have already applied for the SBA economic disaster loan, and that may be in process. And that makes sense because this was put in place a few weeks ago, and we just learned about this whole debt forgiveness option based off the CARES Act. And so there's a couple things to note here. One, there's still no downside to applying for the SBA economic disaster loan because you can receive a grant that's supposed to be within a week or two, a $10,000 grant to help immediately cover payroll, mortgage, rent, etc. So little downside to applying for the economic disaster loan in the sense that you may receive this $10,000 grant. But the disaster loan is different than the forgivable SBA loan. And so you can receive the SBA disaster loan and then refinance it into the forgivable loan. So that's one way. If you're already gone down the track of the SBA disaster loan and you want to take advantage of this forgivable loan, that you can complete that process and then refinance it into the forgivable loan. And then again, once the loan is originated, then the forgiveness calculation is going to be based off your expenses over the next 8 weeks. So in terms of what I would do in this case, if it were me, is if I've already applied for the SBA loan, disaster loan process, and I've received correspondence from the SBA and we're close, probably complete that process and then look to refinance it into the forgivable loan. If I have not applied for the disaster loan, I'm probably going to bias filing for the forgivable loan first, just because of the potential impact. So get that done and then separately consider applying for the disaster loan, mostly just to take advantage of that $10,000 grant. So that would be the flowchart process that I would follow if I were you. So those are the loan pieces, and now I'm going to kind of shift gears into the available credits, deductions associated with the CARES Act. So the first one is sort of what has, I think, been referred to largely as the stimulus check. In the code, it's referred more to as the recovery rebate. And really, this is similar to in years past where there's been a change in the tax code and we've received an advanced check. This is just something that generally in these new tax laws that Congress likes to do is get you some money as soon as possible. But it's effectively an advance on a 2020 credit. So the credit is actually a 2020 tax credit that you're receiving in advance. So they're supposed to mail them out in the next couple of weeks. And the way that they're going to determine if you're eligible for the credit is by looking at your most recently filed return. And so if you have not filed your 2019 return, they're going to look at 2018. And so there's a little bit of a game that you might want to play here because there's some income phase outs. So the credit is $1,200 per individual. So if you're married, $2,400, and then there's $500 for each qualifying child, which is basically a dependent. So someone that you provide more than 50% support who's under the age of 17, they would qualify potentially for an additional $500. If they're 18 years or older and they're not a dependent of yours, then they would potentially qualify for $1,200 each. So there is a bit of, again, planning here as it relates to how you file your 2019 return in terms of reevaluating based off your income and phase out. Is your kid really a dependent of yours? Are you really providing them more than 50% support? If not, it's likely, and they have earned income, wages, self-employment income, etc., that they want to probably go ahead and file a 2019 individual return so that they're going to get this $1,200 credit each. But the credit phases out. I should clarify too, it's based off adjusted gross income, not taxable income. And so the difference here is adjusted gross income would be adding up income from all your different sources, so wages, interest, W-2s, capital gains, etc., minus a few preference deductions, things like self-employment tax, health insurance, etc., will arrive you at your adjusted gross income. Taxable income would be taking that number less standard or itemized deduction. So it's adjusted gross income that we use to determine these phase outs. And so if you're a single filer and you have adjusted gross income that's 75,000 or less, you're going to get the $1,200. If it's between 75 grand and 99,000, you're going to start to phase out that deduction. So once you get to 99,000, the rebate or credit, once you get to that 99,000, the credit goes to zero. And for joint, the numbers are doubled, 150,000, 198,000. There is a number if you file head of household. I didn't include it here. I think it starts at 115,000, the phase out. And happy to, if there's any head of household, happy to look that up. But the game here really is to look at, if you're at all in this window, is to look at your 2018 income compared to your 2019 income to determine whether or not you should file 2019. And because this is really a 2020 credit, if when you go to file your 2020 credit, the amount of the credit should have been more, in other words, your income was less in 2020 than in 2019, and less such that you would have received all of the credit or more of the credit, then you'll be issued that additional credit through filing your 2020 tax return. If your income was more and you should not have received the amount of credit that you got in 2019, you won't have to pay that back. So again, game there is look at your 2019 income and see how it compares to 2018 and get your 2019 return filed if it's going to result in you getting the credit or more of the credit. Otherwise, hold off for 2 to 3 weeks or until you get this check. Also, there's a reprieve on taking out some money from tax-deferred retirement accounts. So typically, if you're not of retirement age and you take out some funds from a tax-deferred retirement account or tax-beneficial retirement account, you're going to pay a 10% penalty. Plus, depending on the type of the account, you have to pay income tax. And so you are allowed to take up to $100,000, and I interpret this as per taxpayer, so $200,000 if you're married filing joint, from your respective accounts without paying the 10% penalty. Again, you may still have to pay income tax depending on if you're taking it from a traditional tax deferred retirement account versus if you're taking it from a Roth. So you may still have the income tax, and you can choose to pay that income tax over a 3-year period rather than all this year. So you may still have the income tax. This is really just waiving the 10% penalty. And the term around whether or not you're a qualifying individual is pretty open-ended. It starts out very specific because it says you or your spouse essentially were diagnosed with COVID-19 and you got tested and from a qualified lab and the results show that you have it. But then it goes on to say that you experienced adverse financial consequences due to being quarantined, furloughed, laid off, and unable to work due to lack of childcare or reduced hours related to your business, so on and so forth. And so that expanded sentence effectively includes everybody at this point. So I don't think there's very many of us in the U.S. who have not experienced some level of financial consequence or have been sheltered in place, quarantined, et cetera, or unable to work due to childcare. So for all intents and purposes, most everybody qualifies to avoid the 10% penalty. And so $100,000 per taxpayer with the option to pay the tax over 3 years. You can also choose to pay it back. So you can take the funds out now and then you can pay it back also over up to a 3-year period. And you're not going to be subject to any of the annual limits for contributions to retirement accounts. So if you need access to the capital now, you can do it and then choose to pay it back later. Also, for all intents and purposes, required minimum distributions. So this is when you are in your retirement years, you're required to take out a certain amount each year. For all intents and purposes, those requirements to take RMDs are waived for 2020. There's a few specific wrinkles to that where it's not every single retirement account, but for sake of not getting super in the weeds, I've left that out. There's a $300 above the line charitable deduction. So earlier when I was talking about adjusted gross income and that calculation, so usually charitable deductions go into to itemized deductions where you claim things like mortgage interest, property tax, et cetera. And so for a lot of folks, especially after the 2017 tax reform where the standard deduction was raised, a lot of folks aren't necessarily itemizing anymore, but you still might have some charitable donations. So at least for this year, you'll be able to deduct $300 against any other income that you have. Also, the limit on cash charitable contributions was 60%, but for all intents and purposes, it's 100% of your taxable income. So you could effectively choose to wipe out all of your taxable income this year through charitable donations, as well as if your employer chooses to pay for some of your student loan repayment, up to $5,250, that's going to be tax-free. So that number, $5,250, may look familiar to you. That is the number that if your employer pays for any qualified education expenses that would be tax-free. Basically, we're just taking that existing bucket and saying your employer could also help you out with student loan payments, and that's going to be tax-free. So I think the play there is that you could essentially get some tax-free money to your employee that's also not going to be subject to payroll taxes. And so rather than a bonus or a catch-up on pay, if you furloughed your employees, if they have student loan debt, you could pay a portion of that and effectively get them that cash. They're not going to pay tax, and you don't have to pay the payroll tax. So that may be one way that you approach that. There are a few other wrinkles or other items that I left out that I don't think are generally applicable to most folks. So then we move over to the employer side of things, and there's an employee retention credit, and the credit is basically a $5,000 credit. It's 50% of wages up to $10,000 in wages. So for all intents and purposes, a credit up to $5,000. But the requirement here is for employers whose operations have been fully or partially suspended as a result of a government order. Employer experienced a greater than 50% reduction in quarterly receipts. So basically, if the way you qualify for this credit is that you take the current quarter or future quarters over the course of this year, and you look at the total amount of revenue that you received, and you compare it to that same quarter in the previous year. And if the amount is 50% or less than the previous year, then you would qualify for this credit. And the credit really is that if you continue to pay wages as well to your employees, you would be able to get 50% of their wages up to $5,000. So this is a tough one because you basically just took a huge haircut to your business revenues, and then you'll get 50% of the wages back up to $5,000. But you're not eligible for this if you are receiving any of the small business interruption loans. So if you got the SBA disaster relief loan or the forgivable loan, you're not eligible for this credit. So that's just something to keep in mind in terms of if it makes sense to pursue this credit versus pursuing some of the loan options. Let's see. All right. There's also a delay on the payment of employer payroll taxes, and this is the portion that an employer pays for Social Security tax. So if you look at any payroll period that you've processed, you'll note that your employee paid 6.2% of their wages to Social Security. They paid 1.45% to Medicare, and then you also matched that Social Security tax. You're paying in 6.2%, and for Social Security, and then separately you're paying 1.45% for Medicare. And so really what this says, and there's some phase outs where based off their wages, the Social Security tax goes away, but let's just keep this simple and assume that for all your employees, especially this time of year, we haven't hit that phase out yet, that you're paying in Social Security tax of 6.2% on all of their wages. And so what this says is that we get to defer paying in the tax to the IRS. So typically you need to pay that within the quarter, and some instances within a week or two of when you process payroll, depending on the size of your company and how frequently you're processing payroll. And what this says is that you still have to pay in any of the Social Security taxes and income taxes and Medicare taxes that you took or withheld from your employees paychecks. You still have to pay that in. You still have to pay in your portion of Medicare tax. And so what's remaining is your portion, the employer's portion of Social Security tax. That's 6.2%. You can defer paying 50% of that tax, so 3.1 percentage points. You can defer paying 50% of it until next December, so December 31st, 2021, and then the remaining 50%, December 31st, 2022. So basically, this is just allow you to defer some of the Social Security tax out, basically out a couple of years. Now, what's interesting is that this waives any potential penalties or really any obligation that the payroll processing company will retain. So if you choose to do this, this deferral, then you'll have to notify your payroll company, and I'm sure they're all scrambling to figure out structurally how this is actually going to work. But if you choose to defer paying in the tax, the payroll processor does not retain any liability. You're personally liable to pay in these taxes. And also, it's not allowed if you have your loan forgiven through the Paycheck Protection Loan Program, which is the debt forgiveness. So if you're using the debt forgiveness, then you can't defer paying the payroll taxes. So I'm pretty reluctant to really recommend clients do this, because from my experience, this is how business really get themselves in trouble. I've seen lots of folks who come to us who got in a cash crunch and they started delaying paying in payroll taxes, and now they're in this cycle where the debt has just really mounted, and it's hard to get out from underneath that. So I would be really reluctant to utilize this benefit, and especially knowing that it's not allowed if you're going to use the Paycheck Protection Loan Program. Couple other things of note: if you experienced a net operating loss, this is effectively where you had negative, for all intents and purposes, simplicity's sake, for a given tax year, you had negative taxable income. You can carry back those losses. And so any NOLs that you incurred in 2018 or 2019, as well as this year, 2020, you can carry them back 5 taxable years. And there's no limit on the percent of taxable income. So under the previous tax law, you could only offset up to 80% of taxable income. Now it's 100% of taxable income. And instead of having to carry it forward, you can carry it back. And so this is just a fancy way of saying that if you had NOLs in the previous years, we can go ahead and carry them back. And also, if you have applied some NOLs and you only apply 80%, we've got an additional 20 percentage points of deduction that we can apply to previous years. So you may have some cash sitting out there based off some operating losses from previous years. A couple other things: if you have business interest deduction, so you incurred some debt maybe to acquire another business or series of businesses or business assets. Previously, you were limited to 30% of your adjusted gross income, and now it's 50%. I don't know that that's going to help many folks here in this audience. And then also there was a correction on bonus depreciation. And this goes back to tax reform and the way that leasehold improvements were described, and it created a technical issue where some of that property didn't meet the definition of bonus depreciation. So if you've had some leasehold improvements and other things that you're depreciating over 39 years, that issue has been corrected. And then lastly, before we get into the Q&A, there are some expanded unemployment benefits. So it increases the unemployment benefits to the federal unemployment benefits to $600 per week through the end of July. This is in addition to any state unemployment compensation that you might receive. So in addition to state unemployment. And this includes self-employed and independent contractors. So anyone who's a 1099, if you're a rideshare employee, if you're wedding photographer, so on and so forth, where you're self-employed or you're an independent contractor, historically you would not qualify for unemployment. And this expands the definition to include you, and you'll receive $600 per week through the end of July. Also, there's state-by-state rules depending on whether or not you'll qualify. So, and those are emergent. In other words, we're getting clarification, kind of a day-to-day basis, on a state-by-state basis of how they're changing or rolling out unemployment benefits. Because historically, if you're self-employed, you just don't qualify for unemployment. And so most states at this point are adjusting that rule through the end of this year. So if you have a state-by-state question, let me know, and I'll look it up for you in our tax research software and let you know. Also, under the expanded unemployment benefits, you'll receive an additional 13 weeks of federal unemployment. So for just about every state in the US, the maximum number of weeks that you can receive state-related unemployment is 26 weeks. And if that's the case and the states have not provided an expansion to their unemployment window, then you will receive an additional 13 weeks at $600 per week through the federal government. Also of note, and I'm still seeking a little bit of clarity on this, but there is an expanded definition of who's going to qualify under the Pandemic Unemployment Assistance Program. And so for folks who otherwise were not eligible, either because your income wasn't sufficient, or you were previously unemployed and your benefits had expired, or you were about to start a job, but that business closed or they weren't able to take you on, you may now qualify for the $600 per week check. So I think there are perhaps some stay-at-home parents, for example, who may actually qualify for this $600 per week benefit. All right, so that's kind of the rundown. What
Cool.
questions do we have? I know that was a lot of information. I just talked for
Yeah.
minutes.
Yeah. So what we'll do, somebody asked for the Cliff Notes, and I said, this is the Cliff Notes.
Yeah, this is distilled down from like 1,200 pages across 3 acts. So unfortunately, this is largely the Cliff Notes, but I am working on a questionnaire where you basically answer some questions based off your scenario, and I'll help guide you towards what things are going to be applicable to you. So I am working on that.
Awesome.
I hope to have it done by tomorrow.
So what we'll do, if we're going to pivot a little bit, and the reason why is the Q&A, we want to answer the questions we want them to ask, or we want you to ask the questions that are going to be most helpful. So we're going to make this replay available. You can go to cfeclass.com/oasis if you want to make sure you get the replay. But we're going to cut off, I'm going to edit out the Q&A, right? And that's just to make sure that we respect your privacy and all that stuff as we're talking. So this is just a cutoff point. We're going to cut off the Q&A, and then we'll continue this for private clients and members. If you want to make sure that you are on all these calls, get all your questions answered, go to CFE class. That's cashflowengineeringclass.com. You'll get the cash flow engineering course. You'll get the Maslow's hierarchy of revenues, which we're teaching live over the next couple of weeks, and 52 weeks of these live calls. So we'll roll right into Q&A. Dan, how much time do we have?
Whatever we need.
All right. We'll go rapid fire. If something requires clarification, we'll get it. First one is, can you use the